Welcome to TMS Insights. Jeremy Hook and Ben Clark bring you a mid-August update as we're in the middle of a reporting season, but also, probably just as importantly, quite a pronounced sell down in the markets. Ben, about 7% decline in the market from August 1 to now, and about 11% since that April high, just under 6,000 points. It's obviously causing some concerns. Let's just probably try to drill down into it. Obviously, bank capital raisings, which we talked about in our last insights. A bit more worries out of China?
Yeah, I think, certainly some concerns out of China. I think widely it's recognised that China is growing at a slower rate than the Chinese government are telling us the country is growing by. That the share market sell-off in China, I think, has something to do with it. But I think there's two main reasons for the recent sell-off. ANZ and Commonwealth Bank have raised $8.5 billion, or in the process of doing that, within a couple of weeks. That's a lot of money for our market to come up with to get into those raisings, and other stocks are being sold to fund that. We must have listened into 30 or 40 results now in the last couple of weeks, and you'd have to say that CEOs widely generally are cautious still. And I think analysts had growth hopes up here, and the CEOs on the calls are bringing them back somewhat. And then we're seeing some price target downgrades, some selling, and some incredible share price reactions to some.
And this is often even after some quite good numbers are presented for the 2015 financial year. The comments coming back are, we're really not that sure, not going to give you guidance or outlook statements, and the market takes that as a negative. And I think they've taken it far too negatively overall as a general thing, and it's leaving a lot of value in the market at the moment. But it does what it does, and it does it for good reasons. But just to drill down into it, on Monday we had Westpac give quarterly numbers. It was also anticipated they might have declared a raising of capital. They didn't. That was somewhat seen as a positive for the banking sector in terms of maybe this round of capital raisings has been dealt with.
Yeah, I think so. And I think we'll look back, give or take a week or a few weeks, and sort of say when CBA elected to raise capital, that was close to the low point for short-term bank share prices. I think the other point as well, Jeremy, is our market is so concentrated, and BHP, Rio, and the four banks and Telstra are pretty much more than 50% of the ASX 200 that you see quoted. And all of those share prices have come off between 15 and 20% in the last few months. And when that happens, it's inevitable our market's going to pull back.
Yeah, that's right. One of the big market heavyweights that you mentioned then has just reported this week, Telstra. We listened into that one again. They weren't great numbers, Ben?
No, I think the numbers came in line, but I think the concerns from the market are that the last 5 years, a lot of the growth has come from the mobile side of the business. And there's signs that the main two competitors there are really fighting back in Optus and also in TPG coming in hard into that market. And the CEO on the call was very adamant that we will do whatever it takes, in his own words, to protect our mobile business, which led the market to think more investment just to maintain market share and margins. And that's maybe just a bit of a concerning sort of trend that's starting to develop there.
And for a business which isn't high growth in itself, whereas other companies that gave similar announcements about investing, we spoke about CSL last time, so we won't do that. But this last week we heard from Invacare, which is investing into the United States, and Seek, which is investing globally, I guess, into its various international businesses. Now, they were treated harshly, both stocks, Invacare and Seek, but they're both high-quality growth companies, aren't they?
Yeah. And look, it's frustrating at times, the market, isn't it? We get frustrated because some companies are coming out and say, we'll lift our dividend 10% and not invest, and they're getting rewarded short-term share price-wise. And these businesses, Andrew Bassett, the CEO of Seek, on the call, sort of was saying to analysts, we're seeing 2 or 3 incredible opportunities to invest in that we think over the next 5 to 10 years will give great results for our shareholders. We'd be crazy not to do it. So, all of you guys, the analysts, are looking 12 months ahead. We're looking 10 years ahead. And if we make our investment decisions on what's going to happen next year rather than what's going to happen in 5 or 10 years, the business would never have got to the size it will, and over time it will fall from grace.
Yes.
So, the share price pullback on the back of that, I think we'd agree is an opportunity.
Yep, absolutely.
But it's probably a longer term opportunity rather
Yeah.
than a trading sort of opportunity.
And to dwell on that point a little bit, I mean, this is exactly what we invest in companies to do, to take growth opportunities that they see, and expert management like Andrew Bassett at Seek are well placed to know the best opportunities for shareholders. The mindless approach to paying out dividends at the expense of growth doesn't deliver best outcomes for shareholders over the long term. So our intention is to find the best quality managers of the best quality assets, and we want them to be investing in the business. As Tony Boyd in the AFR said today, Google or Amazon would never be what they became if they'd paid out dividends or done buybacks rather than invest into their businesses. So we're trying to find more of this kind of business. Today, the stock bounced quite well after being about 11% down yesterday after a very good result. That's Seek. So again, good companies, short-term volatility in share prices shouldn't really be the focus for us, other investors, but they're a factor we have to bear in mind.
Yeah, it's hard to look away from.
It is, yeah. Invacare, though, growing in the US and a good business, so another one we like to hold. Outside that one, we saw Sydney Airport reported. That was good numbers again.
I thought another set of really solid numbers, a couple of great announcements in terms of what they've done with one of their terminals and signing a long-awaited deal with Qantas and Virgin. And, I think that the growth trend there continues.
Yep. And the QBE conference call was another good sort of confident set of numbers and commentary, a very positive sort of feel that we got, and we haven't had that from QBE for 10 years.
It's been growing though, hasn't it?
Yeah, it has been.
The last three calls, I think that you can hear the CEO and CFO getting more confident.
Yeah.
I think that the best sign there was that they've increased their dividend payout ratio from 50 to 65%, which tells us that they are very confident there's no problems anymore in their balance sheet, and they reaffirmed earnings guidance, which I think will probably be conservative.
Yeah.
And, looking forward with rising US interest rates, as a business that's an obvious beneficiary.
And it's going to be an easier business to manage going forward with some of the recent divestments. Certex,
great numbers. Yeah, 70% profit growth.
Yeah.
And yet to, the trial outcome that they recently successfully posted will flow through this financial year. So I still think that looks like a good, riskier sort of growth stock.
Yep.
So still happy to hold that.
Big market heavyweight, our largest employer in Australia, Wesfarmers. Good numbers there. That's encouraging. That's an important part of the Australian economy. It's not happening for every division. Obviously, their industrials division, which and their coal division, poor. But the key divisions, supermarkets, home improvement, going very well.
Absolutely, and that diversification strategy. I mean, Bunnings is 30% of Wesfarmers' earnings, and that's booming. Coles continues to do very well at the expense of Woolies, unfortunately, and the outlook I think is still good, and a strong share price reaction in a pretty down market today.
Big dividend too, $1.11. A couple of energy stocks. The oil price has been savage of late. Woodside and Origin have both reported today, and again, Woodside was yesterday. Not unexpected, but numbers which didn't show growth. But again, outlook statement's pretty important. Yeah,
and I think you've got to place there, oil to us is probably a commodity. We've got very little exposure to a very large area of the market in commodities, but oil is something I think we'd all recognise longer term the globe needs. And an oil price now is at $40. So the oil price now is at a 6-year low. And that's causing significant strain for anyone that's producing oil. Origin, of course, have this big gas project that's coming online. Grant King said today that they'll be making money at the current oil price, but I think only just. And so, if you go back 6 months when oil was $100 a barrel, they were probably going to be making, around sort of $60 US a barrel. Now they're probably making about $1. So the economics have changed, and and hence the reaction. But I would say I don't think the oil price will be $40 forever, but it might take some time for it to start to recover.
There's certainly some big geopolitical games have been going on with OPEC, and that's having a massive impact on these companies. Well, just to finish off, one stock that we've had an eye on for a while and we're waiting for its result to start talking about was Challenger, a financial services group, which has been through some ups and downs, but we think it's really well placed at the moment. A funds management business of some real scale and the annuity and life products, which have got a dominant position in the Australian market.
Absolutely. I mean, Challenger went through a near-death experience in the GFC. It's another one. I think just incidentally, Macquarie. I think sort of something similar.
Yeah.
Both businesses are really hitting their straps, and Challenger are the dominant annuities provider. Annuities are only about 2% of our pension assets in Australia. In America and Europe, they're about 15% of the mix, and Challenger are the dominant provider of them, as I said. And we believe that there's a real structural sort of growth story there, particularly when interest rates start to turn. That's when it will accelerate. Annuities become more attractive.
And that's going to happen at some stage, we all agree, so that'll be a earnings boost for them. At the moment, though, you don't paying a lot to get Challenger shares, 11 times earnings.
11 times earnings, around sort of 10% earnings per share growth they posted, and they've guided again for. The management team seem to have done a great job at turning around the business, and we're very confident. I think we both thought on the call, we weren't hearing many CEOs really sort of saying, like, here's a great set of numbers and our outlook's looking really good. Yeah. It was refreshing to hear and there was a couple of others, but they've been pretty few and far between. But certainly, I think around sort of $7.20, it's looking like a pretty good buy.
Yeah. No,
good dividend as well, and I think they're going to fully frank.
This is the first fully franked dividend, and that'll rise, we believe, that dividend. So good stock to be in, something different, not widely held by a lot of our clients. So again, one to be talking to us about, or anything else. So please give us a call while this market is full of news, but also plenty of action. Look forward to bringing you another update at the end of August.